So we think of the equilibrium level of the balance sheet as driven by demand for our loan.
Hey everyone, me Kevin here. So Jerome Powell is sort of live crashing the market right now, and it's mostly because he's talking about the need to go to potentially more than a 25 basis point hike, and if that time comes, we will do so. I believe what he's trying to do is anchor inflation expectations, but let's take a listen to Jay Powell himself.
Interest rates that actually will be our administered rates that set policy. And so what that means effectively is an ample quantity of reserves plus a buffer plus the other liabilities. Now, as I've mentioned, pardon me, we're a long way from that today. We were fairly close to that level before the pandemic set in, before we, bought quite a lot of assets. And I expect at a coming meeting that we'll begin the process of shrinking the balance sheet. And I said, broadly, that process should take around 3 years. We wouldn't get numerically back to the same level. We'll get roughly to the same level of GDP, I think. And of course, the details will be forthcoming as we get closer and closer to actually agreeing on those precise details.
So tangentially thinking then about the demand for dollars and looking at what's happened to money supply, obviously necessarily increased rather significantly in the immediate aftermath of the pandemic, but now that increase has abated and it's increasing at a slower pace. How do you view this within the policy framework, and what do you do should velocity of money begin to rise?
So we generally think of inflation these days and for the last few decades as mostly about the balance between supply and demand. There was a time in U.S. history, of course, as this audience will know well, when money quantities were thought to be very important in determining output, determining inflation, and things like that. And it makes intuitive sense that would be the case. But, close to 40 years ago, the velocity of money, which is the ratio of output to the quantity of money, stopped having any trend. It was really, there was no steady relationship there, which is to say velocity was no longer constant. So we got away from that, and we look now to supply and demand. I mean, what seems to be causing the current inflation is things that happen, as I mentioned in my speech, that both that demand was strong, but also that it moved from services to a much more constrained goods sector. And then at the same time, the supply curve, if you will, for goods became essentially vertical in some goods. So, for example, when people wanted to buy a lot of cars, they're at home, they don't want to ride public transportation, they've got money on the balance sheet, they're not spending on trip, they want to buy cars. Ordinarily, the car manufacturers would say, this is great, let's make more cars. But you couldn't do that. Actually, car manufacturing declined because of the lack of semiconductors. So that's really what is behind the story here. I don't say there's no role for monetary quantities. And in fact, I would say over time, there probably is a relationship there, but I don't think it's an important part of the story at this time.
Thank you. So let's talk a little bit about something that you've underscored, that you underscored at the press conference on Wednesday, and you underscored in the speech today, which is the strength of the labor market. And I think a lot of us that are looking at the summary of economic projections and looking at the range of outcomes, doing our own forecasts, are concerned that we might see a higher unemployment rate before it falls to the 3.5% forecast. So one, do you see a direct path to 3.5%? And talk to us about how you see the evolution of labor markets in the face of getting to neutral.
Well, I guess where I would start is saying that having a strong labor market, as I mentioned in my remarks, is an important thing, and it's been a big focus, frankly, of my time in this job. In fact, some of you may remember I told a congressional committee a few years ago when unemployment was 3.6% that I didn't see any heat in the labor market because wages weren't moving up, and so. This is something that I personally and my colleagues really want to get back to. The current labor market is though, as I mentioned, there's an imbalance between supply and demand. It is in so many respects much tighter, much hotter than the labor market we had before the crisis. So we have to take that into account in setting policy. There's excess demand. So in principle, less accommodative monetary policy could reduce excess demand for labor and stabilize the unemployment rate while labor force participation moves up, supply moves up, and those the kinds of things that could reduce pressure in the labor market and help to make sure that wages are on a wage percent inflation. But that's our goal. As I mentioned, monetary policy is famously a blunt instrument. But we do place a high priority on a strong labor market. But ultimately, if you want a strong labor market, you have to have price stability. So we're very focused on restoring price stability and also fostering a strong labor.
Okay, let that catch up there for a second. One of the things that's worth noting here that Jay Powell keeps reiterating, and as you watch this, I think it's really important to pay attention to, is what he's doing is he's really trying to tell the market, hey, we gotta get inflation I'm back. Okay, that was annoying. Sorry. Let's keep going to Powell here.
When inflation arrived, it did not appear that this was the classic form of inflation where demand grows and grows and outstrips economic potential and the economy overheats and inflation moves up. Actually, the unemployment rate, I think, was 6% last March, something like that. And the labor force participation rate was a full percentage point below where it is now and 2% where it was before the pandemic. So there appeared to be slack in the labor market. But there is a role for demand. And it is, as you mentioned, it is that demand moved into goods and away from services. It's also that demand was really strong. There was a very strong fiscal reaction. There was a very strong monetary policy reaction. Demand was really strong. Nobody should deny that. But you could not drop that amount of demand into any of our models and produce this kind of inflation without supply side constraints. Mm-hmm. And so that inflation was really a product of strong demand, particularly in goods, meeting the constraints. So now, I guess what we're seeing now from Ukraine is really commodity related and supply chain related, and that is more like a classic supply shock, I suppose. And as I mentioned in my remarks, you would tend to want to look through that. I think we're going to be careful about that because inflation expectations are coexisting apparently with high inflation now, but we want to be very careful about moving expeditiously to get policy to where it needs to be. So I wouldn't say that we're comfortable at all with the typical sort of we'll just look through that approach.
So in that vein, then, what would prevent you from doing a 50 basis point move in May?
Ooh, big questions.
What would prevent us?
Yeah.
Nothing. Executive summary.
Oh, no.
No, as I've said, that's not a decision that we've made. It's not a decision that we've made. What I've said is that if we think it's appropriate to raise 50 basis points at a meeting or meetings, we will do so. And I don't have a test here, but for what will trigger that, but it just is this, we have an expectation. The expectation going into this year was that we would basically see inflation peaking in the first quarter, then maybe leveling out, and then see a lot of progress in the second half. That story has already fallen apart to the extent it continues to fall apart. My colleagues and I may well reach the conclusion that we'll need to move more quickly, and if so, we'll do so.
So there are a number of questions about real rates, neutral rates, yield curve shape. So I guess one of them is, should the Fed be looking at should we be looking at nominal Fed funds or the real Fed funds rate? And what do you expect the real Fed funds rate to be given our current dynamics?
So of course it is real rates that matter in the end, and we're very focused on that. In fact, if you look at where rates are, even real rates for many SEP submissions, they are actually above the estimates of the neutral rate, but not. I admit that the ones for the whole committee are not there yet, but again, I would see it as a work in progress. Ultimately, I guess I would add though that many things other than monetary policy, some things other than monetary policy can work to reduce inflation. And I would point to a slowing in growth from the reopening of the economy, where we had very fast growth. I would point to the waning fiscal policy. I would point still to the possibility of supply side. We are beginning to see some, for example, in the vehicle sector, there is some evidence of progress on supply chains. So all of those things can help. And so it's not necessary for monetary policy to do 100% of the work. But as I mentioned in my remarks, we are not conducting policy now in the expectation that we will see significant near-term progress. We're going to be looking for actual progress at this point.
And that's an important distinction. So there are a number of questions about stagflation, which we all know is high unemployment and high inflation. That is, I think, not the situation we have now, even though people have bandied that word about. And I guess my question centers more around, we had come to believe that the bigger boogeyman was deflation or disinflation. And that, of course, was informed by nearly 40 years of inflation falling and interest rates, nominal rates falling. And when we may be a little bit too quick to declare victory over inflation, and do you still think the prevailing wisdom, certainly in the halls of the Fed, is that disinflation, deflation is the bigger boogeyman, or is inflation the boogeyman that has come back and is the bigger boogeyman?
So all right, so clearly for the last quarter century, we've had a perfect storm of disinflationary forces, really. Demographics, globalization, technology, all came together to create disinflationary forces. Now, it's been argued that there's a number of books that argue that process is over and that we're going to go into a higher inflationary situation. I hadn't found that argument persuasive before the pandemic, and so the question is, we've now had, since that old regime, what's happened is we had a pandemic, we had very historically strong policy support from fiscal policy and monetary policy, and now we have a war that is generating untold, really uncertain economic constraints. And the question is, as we come out the other side of that, it's a really good question. The question is, what will be the nature of that economy? Are we going to go back to slower growth, low productivity, aging population, globalization to some extent still intact, or are we going to go back to a more segmented global economy where the effects of globalization on anyone's ability to raise the price of anything are diminished? And I guess it's really hard to say, but I don't think no one is sitting around at the Fed or anywhere else that I know of just waiting for the old regime to come back. I think people fully appreciate the situation that we're in. It's a series of shocks and events that have happened, and we have a job to do, and we're very focused on doing that job.
So speaking of shocks and events, in my new role as global head of strategy and ESG, I'm thinking a lot about the impact of this transition to net zero and what it's likely to do to the price environment, right? And so here I'm thinking of there are likely to be, I would expect, a number of shocks on our way to net zero. In terms of lumpy policy implementation, uneven global policy implementation, of things like what happened in China with energy prices or what happened in Europe with natural gas. Concurrently, we are also likely to see a lot of, or a growing number of asymmetric idiosyncratic shocks in terms of climate events that put upward pressure on prices sporadically. And I'm just wondering, what is the way that monetary policy might respond to a growing persistence of shocks? And what is, how is the Fed thinking about the possibility of this occurring?
So I think in the short term, these are in the short term, very short term, we're not really thinking of those as things that play into policy today. We, of course, are spending time thinking about how both physical risk and transition risk will play into the economy, into the financial system, into financial institutions, business models, and the safety and soundness of them, and all those sorts of things. So, but I guess I would say, though, that there should be a connection to relative price changes, right? So policy could favor different industries, different sectors, different regions over other ones. And by the way, those are not questions at all for the Fed, in my view. Those are questions for elected representatives, but that could happen. But those are really more relative price changes. Inflation is ultimately a monetary phenomenon, and it isn't clear to me at this point that there should be or would be inflationary effects as opposed to relative price changes, for example, between carbon-intensive activities and non-carbon intensive activities.
Thank you. So I have a number of questions here that you're unlikely to answer. What ability do you put on the likelihood of the U.S. economy experiencing a recession as a result of the current economic challenges faced by the United States? And you went into a number of them, obviously the war in Ukraine.
So I don't see a reason to think that the likelihood of a recession, let's say in the next year, is elevated. And the main reason I don't see that is just that the economy is very, very strong. And I would point to growth, which is still by most forecasters reckoning at or above potential growth. I would also point to the labor market. If you look at the job creation we've had, it's been remarkable, and it has kept going. You mentioned boogieing. I would say that it did that right through the Omicron wave. So it's a strong economy, and I do think that, and I think it's an economy that can handle less accommodative monetary policy.
We have a couple of questions here that throw cold water on jolts. I happen to know from our prep call that you are looking at more than just jolts. So if you could, the job openings, so things. Look at the St. Louis Fed labor market conditions index really suggests an unemployment rate closer to 3%. So if you could, I know you've talked about it extensively, but since there's still questions, just go into a little more detail on the tightness in the labor market that you're seeing and some of the indicators you're looking at.
Sure. So if you look at, anyone can pick a fight with any of these, but basically, though, quits and job openings, quits in particular, and I think as well in some research, the ratio of job openings to job vacancies and wages, of course, they tell a story that is really different from the unemployment. The unemployment rate story at 3.8% it's the outlier in a way, because we had 3.5% unemployment for a long time with very low inflation. So I think the signals that are coming from that broader set of indicators all say that this is a labor market that is out of balance, that really has an excess of demand over supply. That chart that I showed shows that employment plus vacancies is like 5 million jobs higher than the labor force at this time. So that's why you're seeing, widespread reports of job shortages. Surveys are in record territory of that nature. And of course, wages are at 40-year highs. So all of those things, it seems to me, point to just a labor market that in a sense, it's a great labor market. It's great for workers, but we need the labor market to be sustainably tight, meaning it has to be tight in a way that's consistent with 2% inflation over time. And there's good reason to think that this labor market would be at a more sustainable level if some of those indicators, if demand could be brought back in line with supply.
So I think many people in this room are familiar with the interesting work done by Jordan and Singh out of the San Francisco Fed early on in the pandemic, which looked at pandemics throughout history. And I would say at a high level, there's sort of two stylized findings. One is that wages tended to go up, in part because we lost labor in pandemics. And second of all, CapEx tended to fall after pandemics. And here in this, and obviously those previous pandemics, we did not have modern monetary policy, modern fiscal policy. We did not have the institutions that we currently have in their form that we have them. So we've seen a little bit of a different dynamic in terms of CapEx, a somewhat similar dynamic in terms of labor. And I guess my question is, how is the Fed factoring in the trajectory, the likely trajectory of capital expenditure and the likely trajectory of productivity? We had a bit of a productivity surge. And do you think it's possible that we could defy history in the aftermath of this pandemic with regard to CapEx and productivity?
I wouldn't say it's not possible. It's certainly possible. I think productivity in a world where little of what we work on is easily forecastable, little if anything, productivity is just not forecastable with confidence. So it just happens when it wants to happen. And of course, we all wish for more productivity, and it's great to see higher productivity, but the forecasters, and we're no different, tend to assume that whatever level of productivity you're at will migrate back to the longer term trend over time. And the longer term trend is 1.5% or something like that. So that's what most forecasts are made of. You can certainly make a case if you want to that, with the labor shortage, there'll be a lot of investment and the business will have to get done, and there will be investment in automation to replace human labor or to complement human labor. And all of that is a great story. And it may, I do think that will happen in the service industries, because, ultimately the service industries, the public facing service industries will go back to their full output, but probably with fewer people. So you may well have productivity there, which would be great. And that would make these, these high wage increases that we're seeing, more sustainable.
Mm-hmm. So there are a couple of questions regarding long-term inflation target. And one questioner asked, would it make sense to shift the long-term target to 3% to assist with a soft landing and allow for higher nominal rates and a more normalized policy in the long run?
No, that's not something we're looking at. It's not. I think, no.
Okay. So there's a question here about financial conditions and credit spreads, which obviously we've already seen, as you mentioned in your remarks, a tightening of financial conditions. And how specifically is the Fed thinking about financial conditions going forward, especially considering some of the anomalies we're likely to experience as a result of the Ukraine war?
We look at a broad range of financial conditions, not any one thing. It's rates, it's PE multiples, it's credit spreads, it's prices and risk spreads of all kinds. So we look at a broad range of financial conditions, and there are countless financial conditions indexes. We look at all of them and try to make an assessment of how tight financial conditions are, how loose financial conditions are, And, we've seen really since late last year, we've seen the market pricing in a number of rate increases. We've seen financial conditions tightening. We've seen, particularly in fixed income, you've seen longer sovereign rates move up in the United States very substantially, and across the yield curve. So, and that's our policy. Obviously, works through financial conditions. We want to get back to a place that's away from the highly accommodative conditions that we put in place at the acute phase of the pandemic, and we want to do that expeditiously.
So we have a question here about, basically I'll call it the how much pain is the Fed willing to take question. So if the economy enters recession but inflation remains stubbornly high, are you willing to maintain tight policy and exacerbate or prolong a downturn to achieve price stability?
First of all, let me say that we don't think about the pain that the Fed is taking. We think about the public. And again, I'll just say we're very committed to restoring really price stability, and that is the thing that makes us able to pursue a strong labor market in the face of a strong downturn. The world we've been in for 25 years was one where you could really go hard to support the economy when it weakened, because you knew that inflation expectations were anchored and you knew that inflation would stay under control. For the first time in a very long time, we have high inflation, and we know that we need to restore that. We really do. And so I don't see, in the medium term, I don't see a conflict between the two mandates. I think the best thing we can do to get back to where we want, which is a long period of sustained strong labor market conditions, is to restore price stability.
Thank you. So let's see, what I was hoping that might be my last question, because I think that underscores that this is the buck stops here speech. But some of these are great questions, but I know that they're either questions that were already asked or questions you're unlikely to be able to answer.
I'll do a summary too.
So I'm going to go back because there are a number of questions about it. I'm going to amalgamate a few together. So people are very focused on the possibility of 50 basis points at the May meeting, but people are also very focused on the shape of the yield curve and what it might be signaling. I have a feeling I know what your answer is going to be, but I'm going to ask this anyway. Is the Fed concerned at all about the yield curve actually inverting? And if it were to invert, would it impact the pace or magnitude of rate increases?
So we monitor, as I mentioned, a broad range of financial conditions, and the shape of the yield curve is just one thing. We do look at that, and we look at different measures. And frankly, there's good research by staff in the Federal Reserve System that really says to look at the short, the first 18 months of the yield curve, right? And that has 100% of the explanatory power of the yield curve. And it makes sense because, there's a reason why that would be the case. Because if it's inverted, that means the Fed's going to cut, which means the economy is weak. 2s to 10s, it's hard to know why that would. It's hard to have some economic theory of why that would be. Why that would make sense. We of course look at it. I mean, I won't tell you I don't look at it, but I do. I think actually I tend to look at the shorter part of the yield curve though. And again, it's just one of the many things that we look at.
All right. Well, we are at time. Thank you very, very much. This was fabulous.
Thank you. Thank you.
So we'll do a recap here.
Thanks.
Okay, let's just jump right into the recap. There's so much to talk about here. In case you're wondering, this morning I did post a video about an hour ago, and YouTube for some reason didn't allow it to play or whatever after a few minutes. I don't know, some stupid bug happened. So I'm just gonna basically incorporate all of this new information that we have and then just give you the bottom lines of that video that I made this morning. So if you're wondering why a video is private or whatever, it's just going to be part of this video now. Okay, so give me 1 second here, get my bearings, and we'll get started. Okay, geez, wow. Hold on one sec. There's a lot to talk about here. All right. Hey everyone, me Kevin here. We've got to talk about why Jay Powell just crashed the market. We're going to talk about the bond dump. We'll talk about commodities, real estate, some of my favorite tickers. And of course, we got to talk about what the heck Jay Powell just said, which Jay Powell is going to be the start of our conversation here. Just a note, this video is brought to you by two things, metkevin.com/extra and that expiring coupon code for the amazing programs on building your wealth. Link down below. That expiration is coming up in 4 days. And then the price goes up again. Okay, so speaking about prices going up, we just had prices go down in the stock market. Why? What happened here? Well, we had our usual typical retail buying at the open. The last 2 weeks, we have seen a lot of retail buying right at market open, followed by volatility throughout the day. Usually, we've been ending up higher. Over the last week, we've been consistently ending up higher. The problem that we just had is at 9:30 in the morning. Look at this drop right here, 9:30 on the dot, 9:30 right here. We get a plummet. Why? Because Jay Powell's speech gets released on the Federal Reserve website. All of its details get parsed by computers, spit out on the news wires, and the news wires did not like what we saw in that speech, which I'm going to explain. And there are some shifts that have happened since then. Then Jay Powell, we had a little bit of a recovery after the speech was published, but after Jay Powell started talking, he gave his speech and then he answered some Q&A. The market rotated down a little bit more. So what is it that Jerome Powell said? Well, here are the following. This is exactly what Jerome Powell said. He said, quote, if we need to go more than a 25 basis point hike, we will do so. If we need to go above neutral, we will do so. And essentially, I'm going to keep going through this, but I want to give you something that's going to make a lot more sense of this as we go through it. What Jay Powell's trying to do is he's trying to limit inflation expectations. Yesterday, I posted a video and said there are 5 very important things for you to track in this market. 2 out of the 5 things I talked about yesterday were different types of inflation expectations. Consumer inflation expectations, which we'll get more data on at the end of this week. There'll be a new update on what consumer inflation expectations are. And number 2, the market's inflation expectations, which you could track the 5-year break-even chart, which has been peaking lately. And this is a sign of inflation expectations becoming unanchored. Multiple times during Jerome Powell's talk, he talked about the need to keep inflation expectations anchored. It's not so much of a matter that inflation is high. We know that inflation is high. Obviously, that's the obvious problem. But the shift in their path or sort of the course that they take will entirely, in my opinion, be based on inflation expectations. That is, as long as the market and consumers expect that inflation will come down, my belief is that they'll stay on the course of 11 to 17, 25 basis point hikes. That's going to take us all the way basically from 0 to potentially as high as 4.25% on the Fed funds rate. And I think real estate is going to see the biggest short-term impact, short to medium-term impact over the next really 6 months to 2 years because of this increase in rates. The stock market has already discounted a lot of the fact that rates are going to go up, that we will see rates at 2.5% to 3% at the Fed within the next year to year and a half, and then potentially higher thereafter. By 2024, who knows, if inflation stays stubborn, we could be at that 4.25% with 17 rate hikes, which is exactly what we saw at the beginning of the 2000s, which Jay Powell referenced. Jay Powell references the beginning of the century as kind of how they expect to raise rates. And that's what we did in 2004 was 17 25 basis point hikes in a row. The reason the market had some heart palpitations today is because Jay Powell said, if we need to go more than 25 basis points, basically go 50, we will do so. And he was bluntly asked, what's stopping you from going for a 50 basis point hike now? And he said, nothing. Now, we don't actually believe that they're going to go for a 50 basis point hike unless some of the expectations we have start changing. So what expectations did they lay out in the Federal Reserve meeting last week? Well, last week, they told us that before Ukraine, they thought inflation would peak in March and then come down towards, kind of flatten for a little bit in the summer, come down towards the end of the year. Now, and Jay Powell reiterated this today, he said, all of that has fallen apart. Their previous expectation of a peak has fallen apart. Now they believe that inflation will peak in Q3 kind of go flat for a little bit, fall more sharply in Q1 of 2023. But if that also falls apart, then they will hike more. And I think that's what the market here is missing, is the market is freaking out because the market's hearing, oh my gosh, you said maybe we're going to go for a 50 BP hike. But wait a minute. He said, we'll go for a 50 BP hike if the data shows that these expectations are falling apart. And so this is where I've mentioned in many videos that what you want to pay attention to is if you want to know if the Fed's going to go 50, this conversation didn't change anything. All it does is reiterate the fact that you've got to look at the month-over-month data for CPI. We got to see if there's a wage price spiral, which we do not have right now. We do not have a wage price spiral. We want to watch this inflect over the coming months. And of course, we want to watch the 5-year break evens, which I showed you already as spiking, which is a problem. This is a problem. And then we want to watch the consumer sentiment inflation expectations, right? These are some of the 4 core things we want to be paying attention to. There are more. You can watch my video from yesterday from that. But Jerome Powell reiterated how important expectations are here and that inflation is high and that we've got to get this inflation down. In fact, here's some of the other things that he says. He says, we're at this market right now where we cannot assume that supply chains are going to provide relief. Jay Powell told us that, hey, we're starting to see some relief, maybe in like certain auto sectors, but we can't assume that supply chain relief is going to be what's going to move inflation down. He does say it doesn't all have to be the Fed, that waning fiscal support like stimulus, some progress in these supply chains, and maybe less reopening spending, like less travel spending, could potentially bring down inflation naturally. But they're going to respond to the data. And if the data continues to inflect in the wrong direction and there is no Q3 peak of inflation, then they're going to hike 50. Now, Jay Powell didn't give us a time frame, but Waller did. On Friday, Waller told us that we could have a 50 basis point hike, potentially 2 50 basis point hikes at one of the next coming 2 to 3 meetings. So that gave the market a little bit of anxiety, but Jerome Powell today reiterating that, yeah, nothing's stopping us from going 50, that I think is what led the market to be a little bit nervous today. Personally, I don't know that this is too terribly different from what he told us last week. He said he's going to be very data dependent. They have not made the decision. He reiterated that today. They have not made the decision to go with a 50 basis point hike. We recognize that inflation is too high, but we're just going to respond to the incoming data. So I've already talked to you about what data to monitor. We're going to monitor this. Market's a little bit nervous about just Jay Powell even mentioning nothing stopping us about a 50, right? But let's talk about some things that are really good that he talked about. So one of the things that he was asked is, wait, what are the odds of a recession? And he says, quote, I don't see a recession likelihood that is elevated. And the main reason for that is the economy is still very strong. He says, look at growth. We're at or above potential. This is reiterating what he said during the FOMC meeting in the summary of economic projections that, hey, look, we're still expecting 2.9% GDP growth. That's more than what we would have had in any period of time prior to the pandemic, post the Great Recession. So this is remarkable growth. He said the labor market is doing very, very well. And that ultimately, yeah, while we're committed to restoring price stability, we at the same time want to make sure we maintain a strong labor market. And these things can go counter to each other, right? For example, if you go all in on fighting inflation, you could end up leading people to lose jobs. But you can't have inflation going forever because then you could end up unwinding a strong labor market, right? So a lot of complicated things to balance here. Right now, for me, I don't think much has changed beyond this. We're just going to go 25, 25, 25, 25 until and unless that data starts looking uglier, which we know March's data is already going to look ugly because of Ukraine. We're going to be paying a lot more attention to that data for the months of April, May, June, July. And maybe this is just the Fed kind of throwing it out there that, hey, just remember 50 BP is a possibility, which that makes sense. When he talked a little bit, or when he was asked about the 10-2 yield curve, this is a big one. So the 10-2 continues to flatten. In fact, I'll pull up the new 10-2 right now. And it flattened quite a bit as well after Powell spoke. And we know that the 10-2 can be a little bit of a signal for a potential recession. In fact, anytime the 10-2 has inverted before, we've had a recession within 18 months, right? The current 10-2 has a spread of about 18.8. In fact, if you just look down here under where I am right here, 18.8 is the current spread. It's at the lowest point that it's really been at. And we're seeing 10-year treasury spike. When Jerome Powell was asked about the 10-2, he made a very interesting comment. He said, while he looks at the 10-2, he focuses much more on the shorter end of the curve. He focuses much more on the first 18 months. And this makes a lot of sense to me. In fact, in the video that I posted this morning, but then I made private because YouTube wasn't playing it. It was a disaster this morning. One of the things I mentioned in it is you might consider looking at the 3-month to the 10-year. And the reason you might want to look at that spread is because it shows you a little bit more of how the shorter portion of the curve could impact the yield curve a lot. And take a look. When you go really short, look at the yield curve over here. It bottomed at just after the invasion here in Ukraine, 224. We saw a collapse of that curve, and it's really started steepening again here. Why would the yield curve start steepening again on these when we look at the shorter ones, like the 3-month to the 10-year? Well, in my opinion, as markets get less fearful about the fact that, yeah, inflation's high. Yeah, we're at war with Ukraine. Yeah, oil prices are high. Yeah, gas prices are high. Yeah, food prices are high. The more we become comfortable realizing, okay, we've got a bunch of bad news. Got it. What happens? Well, people start dumping their hedges in bonds. So they start dumping the 3-month bonds. They start dumping the 1-year bonds and the 2-year bonds. They start dumping these, and that leads the yield on those to actually go higher faster. Why? Because when you get these moving, when you dump the shorter term bonds, you increase the yield of the shorter term bonds. That makes sense. Price goes down, yield goes up. So it's interesting to me that Jay Powell says, hey, we like to look at the short end of the curve, like that 18-month curve, because in my opinion, what he's trying to say here is, hey, we're looking at how the market is reacting to fear. When markets are fearful, people go buy the short-term bonds. When they're less fearful, they start dumping the short-term bonds. So for me, I had a similar kind of reaction to Jay Powell just had this morning in my video, which I wish was still available for you. But anyway, in the video that I posted this morning, I said, I've kind of gotten tired looking at the 10-2 yield curve because I think it's totally manipulated because of the disaster that's happening in Ukraine and people using bonds as hedges. Jay Powell kind of said something similar here. He said, look, we're not looking so much at the 10-2. It's a weird phenomenon. It's just one of the things we look at. We look at a lot of things. We look at PE multiples, risk spreads, a broad range of conditions, he says. And the focus really right now is, hey, we do have to focus on inflation and those inflation expectations. That's a critical piece that he talked about. And I think it's one that it's very easy for market, or inflation expectations are one that are very easy for markets to kind of sort of just like bypass, because if inflation expectations, and this is such a weird thing, if inflation expectations are really high, then what happens? Inflation becomes self-fulfilling. This is really like a bizarre phenomenon, but basically the way this works is if you think inflation is going to be 10% this year, 10% next year, 10% the year after, what happens? Well, you as a consumer are more likely to buy things today rather than next year. If you think inflation is going to stay around for, let's say, the next 4 years, 10% every single year, you're more likely to buy a computer today. You're more likely to buy a car today because you think those things are going to continue to get more expensive. Just like when we increase the price of the courses, which the next increase happens in 4 days, you're more likely to buy before because you want to have a lower price. This makes sense. But what that actually does is it reiterates, it sort of self-fulfills inflation in broader markets. When people know that prices are going to go up, they move their purchases up. And what happens? Well, now the market overall sees more inflation. And this is why the two massive things the Fed pays attention to are not just what actually the inflation rate is. Write that down. So what is the current rate of CPI? But it's also those expectations. And we have those two ways, which we talked about earlier in this video, to measure those expectations. And those are things like looking at the 5-year break evens and, of course, the consumer sentiment inflation expectations, right? Which on Friday we'll get new numbers on this. The 5-year break even, you could just watch the chart on every single day. And that is a chart that has been steepening. So when Powell comes out and we have these Fed speak periods, which we talked about this in the course member live stream this morning, there's a lot of Fed speak coming up. I'll give you the calendar really quick here. It is, it's on this phone. When the Fed comes out to speak, what they're really trying to do is they're trying to manipulate expectations down to make sure that people don't basically let these inflation expectations get unanchored. Because once inflation expectations go unanchored, what happens? You end up having to force a recession. The Federal Reserve, remember this, can wave a wand and force a recession. Unfortunately, that comes at the cost of high unemployment, so it hurts poor people even more, which is a problem, or even medium income people. But look at the schedule that we have. Bostic spoke this morning. Powell just spoke. We've got Daly speaking tomorrow. Mester speaks tomorrow. Bullard speaks on Wednesday. He's a pretty big hawk. Kashkari speaks on Thursday. Evans speaks on Thursday. And then we get our consumer expectations on the 25th, which is Friday. And Barkin also discusses inflation on the 25th. So you've got a whole week of the Federal Reserve coming out and giving us this kind of nonsense. So expect a lot of volatility this week, which previously I wasn't expecting. I thought this would have been a little bit more of a calm week. But with this Fed speak schedule, it's just going to be more and more of these Fed headlines. So, okay, so we talked about JPOW. We talked about the bond dump. We talked about, now we got to talk about real estate, commodities, and some stocks. So I want to touch on real estate. This rise in the 10-year curve is a problem for real estate. Remember, I've previously and many times before on this channel said that I believe the 10-year Treasury bond is going to run up to 3%. And let me tell you about what that means for real estate. But I do want to give a quick message and shout out to our sponsor today, and that is Extra. Remember, if you want to get into real estate, you got to have a good credit score. And one of the neat things about the Extra debit card is it kind of gives you the credit of having a credit card without actually having the risk of having a credit card. The way it works is you go to metkevin.com/extra, sign up, link this to your existing bank account. And then when you spend money on this card, Extra will pay themselves back the next business day. And then they'll report those balances they lent you essentially overnight, over business night. They'll report those balances as paid to the credit bureaus. And it says if you can grow your credit score by using a debit card without having the risks of a credit card. They've also got a rewards program, which is amazing. Go learn more about Extra at metkevin.com/extra. Okay, so let's talk about real estate. Well, you got to look at the 10-year Treasury. And this morning, when I woke up, I go, oh gosh, man, the 10-year went to 2.24%. Remember, I've been shorting the 10-year Treasuries. I've been shorting them since under 2% because I'm like, these things are going well over 2%. Now, I closed my short on the 10-year Treasury. I should have closed it today. I would have had, a little bit more profit on it, maybe another 1 or 2%. Big deal. But the point is, like directionally, these 10 years keep going up. Look at them now. They're almost 3%. This is insane. Tomorrow, we're going to see the highest mortgage rates that we have seen since 2018. And I tell you, I think this is just the beginning. I think we're going to go back to that 3-year, 10-year Treasury yield. I don't think it's all going to happen immediately. In the short term, I wouldn't be surprised to see this 10-year fluctuate between 2.1 and like 2.5%, fluctuate around. But over the medium term, which is like 6 to 18 months, it wouldn't surprise me to see us go back to that 3%, which would be the equivalent of about a 5 to 5.25% mortgage rate. And I think we're going to see headwinds against the real estate market, probably in the neighborhood of 20, 25% in sapped purchasing power. That doesn't mean prices will go down that much. I think that'll just offset all of this excess demand that we have in real estate. And maybe we only end up seeing like a sort of a soft move down in real estate prices somewhere in the direction of 5-10% until rates start coming down again, which we expect rates will start coming down again probably end of 2024, maybe 2025, something like that. So that's something to keep an eye on. Remember, J. Powell tells us no risk of recession. We've just got to make sure we keep those inflation expectations anchored. But yeah, we are going to go up just like we did at the beginning of the 2000s. Many rate increases over time. And so this is a headwind that I definitely see for real estate. Okay, so we talked about JPOW. We talked about the bond dump and how complicated these bonds are being right now. Talked about real estate. I do briefly want to look at some of the individual charts that we're seeing here. So this is the Nasdaq. Obviously, we were having a pretty decent day sitting around that 38.2% Fibonacci until JPOW started talking, and he really pushed us right back down. We're sitting right now about 348, still nicely above that. Actually, we're just barely below the 38.2 Fibonacci here. So we're still moving nicely up. And for me, A lot of folks are asking me, Kevin, when would you short in this market again? I'm not really interested in shorting or hedging to the downside until I see the indices get back to about that 61 to 78% retracement. When we get back into this territory, or imagine we get some crazy euphoric week or something, and we get into this territory over here, this is when I think it's going to make sense to short the market. Or to at least hedge, because I don't really like, it's going to take a lot for us to get back to this 318 QQQ, in my opinion. We've already got so much freaking bad news priced in that it's going to take a lot to really push us down and keep us down, in my opinion. And that's why I think also today, we saw a little bit of a push down, but we're no lower than where we were this morning on just typical trading and no news from the Fed, right? So really, we've gone nowhere is really what it feels like here, which is fine. So where are the opportunities? Well, if you believe a recession is coming, you do not want to be in the stock. I have said this since I originally started talking about the stock. You do not want to be in Affirm Holdings if you think we are going into a recession. However, if you think, like Jerome Powell, that the odds of a recession are low, in an inflationary time, a company like Affirm could actually do quite well. The reason a company like Affirm could actually do quite well is, first of all, we've barely retraced anything off the bottom here, which, if anything, gives you a greater potential fear factor. That does it mean that we've actually hit a bottom here on Affirm, right? Could Affirm go even lower? It absolutely could, especially if the market price is in more of a risk of a recession. But I have a belief that in an inflationary time, absent a recession, people are going to be more likely to want to use things like the Affirm debit card and essentially use buy now, pay later services on things like their general purchases, which you could then apply using the Affirm debit card to a sort of buy now, pay later plan. Now, I don't recommend this, but I also don't think the people who use this stuff watch my videos. I really don't recommend people spend money they don't have ever. Some people are like, hey, Kevin, I really like the fact that I could check out for your courses with PayPal and do pay in 4 or whatever. I'm like, whatever. I don't recommend it, but if you want to use that, you can. So I think if we're in an inflationary time, absent a recession, there could be an opportunity to invest in a company like Affirm and probably see them come back to this 38 to 50% Fibonacci here. No guarantees. Certainly not this insane euphoria that we had over here at like 177, 143. I was a seller of Affirm over in this area here because it was just pure euphoria. But somewhere at this midpoint retracement, I see that. We're kind of already seeing those midpoint retracements in stocks like Enphase already above the 38.2. We're seeing that sort of midpoint retracement on stocks like Tesla also already over that 38.2. And so there is some argument that maybe it makes sense to look at other companies like even Roblox, Affirm, or whatever that just still haven't even gotten to their first level of retracement. Just be careful with these. I would keep these at lower portions of your portfolio. A bigger concern that I actually have, though, is the consumer discretionary spend in general. And that would be like your Shopify. So Shopify is another one that's really struggling to go anywhere. And the reason here, in my opinion, just like J. Powell said, is people are probably more likely to save money or spend less money, just like the Chinese are doing. Why? Because we're at a very uncertain time. Gas prices are high, food prices are high, everything's getting more expensive. And so it's likely that you would spend less money on Shopify or Etsy, right? And see, look, this is why Etsy continues to get rejected by the 23.6. Consumers are going to be a little bit weaker. The same is going to be true of the lending platforms. To some degree, that includes Square and PayPal, but probably to a more greater degree, it includes the student loan company and mortgager SoFi. They've also got their brokerage division, which all three of those things, mortgages, student loans, and brokeraging, like Robinhood kind of stuff, right? Trading. I think all three of those have huge anchors on their business, which is not great. People who have made new accounts for savings via SoFi or PayPal or Square probably already did so during the stimulus era. Now it's really tough. People are spending even more money to try to get more customers here. And this is why I'm purposely trying to stay away from some of the lending companies. I'm trying to stay or at least limit my exposure to them because I do have a little bit of SoFi, just like I have a little bit of Palantir. But I'm trying to limit my exposure to them. And I'm trying to go heavier when I get little dips, especially if I get under 60 on Trade Desk. I'm really trying to pick up a lot of Trade Desk under 60. The reason for that is because I really think we're going to see a big move into advertising. And as companies try to spend more money, either partnering with companies like Affirm for buy now, pay later, or advertising companies to fight for the consumers who are willing to spend. So these are just some ideas that I have in terms of stocks that I'm watching. Obviously, I'm also keeping an eye on what's happening with Occidental Petroleum here. It is now at another all-time high over here. I mean, I shouldn't say all-time high, post 2018 kind of high. And this, in my opinion, has a lot of retail momentum in it. In fact, it's not even just my opinion. I could tell you what the most popular retail stocks are right now. They are, yep, okay. So retail, trading flows, Alibaba, Neo, Occidental, XLE. You're actually seeing some expansion over some buy the dip on Jets, which I'd be a little bit more careful about that one. One I do agree with personally would be like a Taiwan Semiconductors. Talked about them on my video yesterday. But I do think that commodities like USO, wheat, corn, Occidental, these are going to see a peak at some point. I've got a Fibonacci drawn over here on USO, and I'm looking for an opportunity to probably short USO if we end up somewhere between the 61.8 to 78.6 fib over here, because I don't think we're going to get to the same sort of peak fear moment we had up here, but certainly somewhere in the 80s for USO is going to be a potential opportunity to short, unless, of course, you expect commodities to keep going. Keep your shorts small, though, because, shorts can be very dangerous. But again, in terms of real downside protection, I'm waiting until the QQQ and SPY get a little bit more euphoric. Today's sort of hemming and hawing here, not a surprise to me that the market's taking a little bit of a breather after J. Powell comes out and just even mentions, hey, nothing's stopping us from doing the 50 BP hike. But really, in my opinion, this is his way of trying to arm wrestle those inflation expectations down. That's the whole point of him coming out and yapping, is to try to make the markets price in less inflation so that way they don't actually have to hike 50. So that's my thesis. Anyway, if you found this video helpful, consider sharing it. Make sure to check out Extra by going to metkevin.com/extra. Check out the programs on building your wealth, metkevin.com/join, also linked down below. And thanks so much for being here. We'll see you in the very next one. Thanks again.